Hi everyone, thank you so much for attending our next webinar. And today I'm delighted to be joined by Leanne Livingston, who's an expert in finding funding solutions for scaling SMEs. Just as a bit of background, we started doing these webinars last October with the aim of giving something sort of insightful for scaling businesses. So hopefully you'll find today's session really valuable. By way of background, my name's Kate Clark, and I'm a chartered accountant turned executive search headhunter. So we specialise in placing the top level finance professional in scaling businesses. And one of the things that we've been sort of made aware of as we've been doing this over the last few years is that funding is often at the forefront of small businesses to get to that next level, and hence why I thought it'd be really valuable to invite Leanne here today to talk through the options that are out there. So I'm just going to let Leanne introduce herself, and then we'll go through our questions.
Great, thanks very much, Kate. So yeah, I'm Leanne Livingstone of Mendip Funding Solutions. You can have a look at my website, mendipfundingsolutions.co.uk. A very brief background on me. I stayed in Bristol after my degree, joined Ernst & Young, did tax, and then moved into banking with Barclays after the financial crisis in 2008. I then gained more experience with HSBC, and then more latterly went back into accountancy with a top 10 firm, RSM, as a debt advisory director, and have recently set up on my own.
Which is exciting.
Very exciting.
Welcome to the world of being a business owner.
Thanks. I love it.
Yeah, no, absolutely. And when we met, I was just like, I was so impressed with your background, and I just wanted to give you the opportunity to talk to our audience. So and I know that you've got so much value to give. So really, really excited about today's webinar.
Oh,
so I guess no, that's quite right. I guess the main place to start is actually talking through, as an SME business owner, what are your funding options? I know that you've got so much knowledge of this. So if I could let you just sort of summarize that'd be amazing.
Yeah. So I think the SME space is a really interesting one, because presumably we're talking about just after startup, but typically it's companies which are growing from having, especially in technology, having just recently been a startup. And in that SME space, you're really trying to convince the lender like why they should invest through debt in your business. Also, typically companies are owner managed, so there's not a corporate board sitting there. So you've often got people who don't have finance backgrounds, probably don't even have accountancy backgrounds, who are just really good or had a great idea, and suddenly they've got funding challenges. They probably don't have a detailed understanding of cash flow and forecasting and all of these accounting terms. And so there's a lot of help that these people need to actually make the right decisions and get the right funding solutions in place. And I'd say one of the things that business owners tend to really struggle with is they'll enter into an agreement because it's something that's offered to them, rather than it being the right funding solution for their business. And I saw that so much in banking, with companies that have just got an overdraft and actually the business is growing fast and they should have a working capital solution, or technology businesses that have taken expensive debt when actually they've built an ARR base and they could fund that. Would it be useful if I just showed you a slide, which sometimes I use?
I was going to say, I was aware that
Let me just see if I can pop this up. Yeah,
no, it's fantastic.
Okay, so I think it's really important to understand that the debt available to you as a business changes with the maturity of your business. So we all know about the 7-year business cycle. It is cyclical. Businesses go up, they go down, they go up again. And I'm just going to talk through this slide. So in the bottom left-hand corner, we're on the startup. And this is where you just want to get cash from anyone who'll give it to you. So family, fools, friends, any free cash. So grants, subsidies, anything out there, just exhaust all of those opportunities. Crowdfunding as well. And then as your business becomes more established, you think, actually, I've really got something here, this is going to work, and you're looking at some forecasts, then you can start talking to venture capitalists. And all that means is someone who's willing to take a bigger pun on something than a bank, but they obviously want a bigger return for that as well. So it's quite expensive. But really good things about going into the venture capital, venture debt world is you get access to a great network that you might not already have. And also having that first investment shows that someone's believed in you. So that's a really good start to your journey. And then as you start to get up, hopefully you've at least got a forecast of a break-even point by this stage. And it's really here where you start to you move away from equity and more into debt, because once you've broken even, I mean, most lenders will want 3 years of trading profit. There are some who will take a view on a break even and a forecast of profit in the next year, but most want 3 years trading history showing you can do it and you can make money, generate cash. And the really basic reason for that is if you're looking to take on debt, you need to have cash to repay the debt. So if you're not breaking even, you're not generating cash, how can you service the debt?
So if you've only just had your first year of making a profit, then that's probably too soon.
It depends.
Okay.
It depends, like everything, because obviously the difference between profit and EBITDA is the difference between profit and cash.
Mm-hmm.
So a business and technology is a really interesting sector for this. At a profit level, maybe making no money, or a capital intensive business because you've got a load of depreciation, amortization. Yeah, so you look like you're making no money, but actually that's why it's really important to go back up to EBITDA level and go, actually, how much cash has the business got? Because you do see businesses, 0 profit, 500 grand cash, and you're like, hang on, that doesn't make any sense. So we have to understand that relationship and the build between those two. So it's not always a no. It does depend on the sector, the business, and actually how cash intensive that business is. And obviously businesses use cash to grow as well. So if you can see that actually the profit's down there because there's been a lot of cash investment, then I'd say there's a case for debt. And sometimes you can actually backdate and refinance existing cash that's already been invested. So you could say, I spent 100 grand opening a new restaurant last year. And the bank might say, great, okay, we can see you're turning a profit on that. Actually, why don't we give you that 100 grand back? And we'll term it out over 5 years for you. And you can put that back into your next restaurant.
Okay, that's really useful.
So as we go through, I've got marked on here tipping point. This is really crude. It's not always the right rule, but generally the bottom left-hand side, you're likely to need to give away some equity rather than being able to get debt. As you transition through to making profit, this is where you get all the interest. This is where you've got private equity, start looking at it going, say, want fast growth. They're like, great, who's in this space? You're also, because you're making profit, hopefully you've got some money you can actually keep in the business and start reinvesting those profits to fund your own growth. So you don't need to go straight out and get debt. And also we see business owners at this point are not necessarily taking a lot of money from the business typically. So it's also really interesting from the lender's perspective. One of the key questions is how much are the shareholders taking out? Because when you go to the bank and you say, I want a loan, but then you're taking 300 grand out, it's very difficult to get credit to see that positively.
Just on that, so I've wondered about this point historically in terms of like so obviously when you get to private equity, they look to make sure that actually, they will adjust your EBITDA if you're not paying yourself enough, because obviously, once you're gone from the business, they will need to bring someone else in to replace you. So they look to see that actually, you are taking out some form of salary that is reflective. But what would you say the banks would say is too much for, let's say it's an SME business owner, 20 million pound turnover business, is there a rule of thumb on that? Because I'd be so interested.
Yeah, I think the perspective is two main things. One is how much is the owner paying themselves in comparison to how much the business has made?
Yeah.
And the other is what's the kind of going rate for that role in the market? So are they paying themselves 300 grand when actually really, as an FD, when an FD might be on 100 grand? So
yeah, exactly. So in my head, I was always thinking sort of 100 to 150 for a CEO of an SME. Yeah.
Okay. So I think as long as it's fair, and if you've made 100 grand profit and you've taken out 100 grand, you're not leaving anything in the business. And so effectively, if you're doing that as a business owner, you're saying to the banks, look, I don't want to take any risk here because I'm paying myself fine, but can you put some money in my business, please?
Yeah.
So at this early stage, when you're making those first profits, it's really important to show the lenders that you're fully invested and you are still taking risk yourself. And so I'm not saying don't pay yourself. The banks absolutely understand people need to make a living, and just say it needs to be reasonable, and just be really conscious of that the lenders will ask those questions. They will want to understand the drawings and the commitments, and also things like shareholder debt, which is built up over a period of years just sitting there. The bank will ask the question, if we're putting the money in, are you just going to quickly repay yourself or is it staying in the business? So yeah, so we're coming through, we're making money, hopefully profits, we're keeping some cash in the business. Private equity are going to get interested, and I've said strategic investors because there's just other investors these days as well who will be calling you. And then it's really, you don't obviously have to do PE. Lots of companies don't do PE, but it's once you get past that high growth, that's when the mainstream lenders are liking you. If you've got like 3 years track record of solid, consistent growth year on year, and I'm not talking about sales growth, I'm talking about cash and profit growth. The banks see through the famous kick curve. So we've seen enough of those. What cash are you making? What profit are you making? And then you're getting into a competitive space, and you can potentially refinance out of some of the debt that you might have taken on through your high risk period, so your expensive debt earlier on. And hopefully after this, when you're into the bank debt, you're looking at better pricing, hopefully better security structures and reasonable covenants. And below that space, you're going to be paying more on interest. You might have to give away more on security, like PGs, for example. And so this is a good space to get to. And then when I say maturing here, what I mean is it's a business which has got a track record, 5-10 years track record. There may be a blip, but there's some history there. And then from here, when businesses hit that point of maturity, they've got to decide what they're doing next. Do they continue growing? Do they just stay steady? Is it a cash cow or a lifestyle business? And some businesses obviously sadly go into decline for different reasons. And then again, at this point, you've got different options opening up to you. With your growth phase, you're kind of back to where you were, but you're an established business now, so you can demand better rates, prime lenders. And if you're saying steady, it's just all about probably sticking with your bank or going to a better bank to get a better rate and just keep people doing more of the same, and maybe making the decision, do you want to pay the debt down to take more money out, or do you want to happy to reinvest, leave the money in? And then also just flagging here, when a business is declining, it's a really difficult decision when you see a company, and I have seen it, like, it's profitable, it's naught, it's minus 250, it's minus 500, and they say, oh, I'm going to turn around. There are lenders out there that will support in those circumstances, but statistically, only 1 in 10 businesses going down that curve will come back up. So it's a very tough space to lend in, but there are specialist restructuring lenders who will buy out of pre-pack or just before a pre-pack. And the reason they do that is because they're taking advantage, obviously they're getting cheap assets. And typically they have a portfolio. So there'll be certain sectors where, so say they've got 3 aerospace manufacturers, and then there's a 4th one there that actually complements 1 or 2 of those other 3. They're like, well, I'll snatch up that asset. I can bring these 4 together in a group and spin them on in 2 years' time at a profit.
Just bolt them up.
Yeah. So that's your kind of curve, really.
Okay, and that's interesting. And one point you raised there about sort of potentially getting a better deal. How often would you recommend that a business owner sort of looks at the financing they've got and looks around to see if they can get a better deal?
Yeah, I mean, it's definitely something that I think a business owner should be constantly evaluating, and by that I mean a couple of times a year. But
Okay.
First of all, just beware of your existing facility. So most bank facilities, not even debt, will be renewable every 12 months. So
Okay.
You've got at least an annual opportunity, and have a look at that 3 months before the renewal, because that gives you time to go and have a chat with some other banks as well, and you're not suddenly in a situation where you have to renew. If you've got term debt, just understanding, if I've taken out a 5-year loan, where are my break clauses in that 5 years? Sometimes it's too expensive to break out of the facility, in which case just leave it sitting there, pay it back. Or if the market has moved, like recently, the base rates come down again. So perhaps someone that took out a 5-year loan 2 years ago might be well off looking at that now. If perhaps the business wasn't performing 2 years ago and they've paid a higher margin, you might be able to refinance that on better terms with a high street bank now if you're now performing and the rates come down.
Yeah, no, that makes sense. No, I guess that sort of brings me on to my next sort of proper question, which is, what should business owners look at in terms of, the documentation? So when they're reviewing sort of the loan or investment documentation, what are the key things that they should be sort of trying to identify there? Because these things are invariably way too long.
Crazy amount of information. I've actually got a slide on this as well. Bear with me. Here we go. I like to break this out between financial and non-financial, because
Okay.
I think back decades ago, the banks were very focused on, is it a business we understand? Is it making money? Do we like the people? And it was much more high level. And also a lot of data was only available, it was historic, because we didn't have accounting packages which are as sophisticated as they are now. And so a lot of SMEs just did not have, current year-to-date management information as of last week, whereas lots of companies now are producing monthly MI within 5 days of month end, which is crazy. So back then, banks were having to make those decisions based on far less information. And then as we've seen over the years, all these technology, AIs come in, it's improving and broadening the things that SMEs can do that maybe large corporates were only able to do 20 years ago. And the banks know that. So the bank's like, well, actually, I don't want your historic. Well, I do want your historic 3 years. That's great. But actually, that's so old. I want your year to date. I want your forecasts. And not just 1 year forecast. Actually, I'd quite like a 3-year forecast if I'm going to give you a 3-year loan. And then it's such, you don't just want your P&L forecast. I want to see what your cash is doing over the next 3 years. Actually, I'm really interested in what your cash is going to do in the next 12 months in particular, because that's our biggest risk, where we've just given you the money. So can you give me that quarterly or sometimes even monthly? And there's a lot of work on the financial side. There's also a thing which came in, I'm going to say about 10 years ago, it might have been before that, around sensitivity testing. So this is where the banks over the last 15 years have really tried to focus on sectors. And it's for obvious reasons, right? Sectors struggle, there's winners and losers for the same reasons in different sectors, if that makes sense. So there are trends that the banks can track. So if you think about a company that, say, only has 3 debtors, and so they'll want to sensitize what happens if your 40% debtor renews with someone else next time. What does your P&L look like then? What does your cash look like then? For farming, the sensitivity testing might be to do with, well, actually, what if we have a terrible summer next year? What crops are you going to produce? Or, so it's trying to pick up on these non-financial factors which have a financial impact, and the non-financial factors will be specific to that business and that sector. So there'll be known things that you'll be sensitizing for when you're analysing that as part of a lending application. And then we're going into the ratios and covenants. There's a whole suite of covenants that the lenders will use, but in the main, most of them are debt service is probably the most common one. So it's how much cash have you got to actually repay your debt, and how many times over. So how big is your comfort on that? And so the banks brought in, so the focus was always on EBITDA ratio, which I'm sure everyone on the call knows about. And then there was like a moment where they went, EBITDA is important, but actually, maybe we should just be purely focusing on cash. And so they brought in this cash flow available for debt service. And I think it's a template that most of the lenders use now. And what it does is it takes your EBITDA, and then you have an opportunity to add and take off all of the other nuances, which are cash impacts. And so it's quite detailed, and actually it's really quite complex to complete. But what you're saying is, okay, your cash flow forecast might show that you're going to have this position in a year's time, but actually you're also forecasting that you're going to move warehouses. You're going to invest in an FD instead of a finance manager. So here's your chance to put in your cash impacts of what if it doesn't go right, or or the FX rate goes against you. And so you actually get to see an adjusted EBITDA on a cash, like a net cash basis. So often there's covenants around that as well now. And then in non-financial, so again, back in the day, we remember when SWOT was a thing, and people know LePest or PESTLE, so looking at economic factors, political factors, what's going on in that industry, what's the risk that if you're a government contractor, that the government changed their policy, like, look at the housing sector recently. That's in favour now. Wow, let's build a load of houses. Yeah, that's great. What happens if someone else gets in next time and actually we're not building any more houses? So what, how vulnerable are you to those external factors? You then had, probably everybody remembers, the bank bashing that went on and the big fines. And I think, I'm not going to name any banks actually at all, but some banks got fined serious amounts of money in Mexico and places like that, because they were facilitating money laundering across the board. And I think as banking's gone global, international payments, electronic payment, all of this, it's made it so difficult for the banks to really know who they're moving money for. So there was a massive thing that kicked off over sort of 5-10 year period, and the banks had to do, it was called remediation, and they had to trawl through every single customer that they had, redoing identification and verification. And I'm sure people on this call will remember that happening, and it was painful for everybody. It really was. So now it's never been more important to just give that, have that information ready, just give it. The banks are going to ask you for it. You can't, I would get a lot of business owners going, oh, I gave that to you 23 years ago. It's like, well, yeah. I know, but we kind of want to see it again. I know it's painful. Can you just do it? And then really interesting, thinking about globalization and more companies expanding internationally, working cross jurisdictions, you bring in country risk. So country risk, people might think, what does that mean? Well, bluntly, there's if you Google it, there's a global chart, and every country in the world has been ranked on bribery and corruption risk, financial crime risk. And so it was, okay, if I'm banking a business and they're operating in, and I did have clients that operated in 100 countries. It's like, well, which countries are they? Are 86 of them in these high risk, or actually are they okay? And so we started to have to understand, where's the revenue going? Who's receiving the revenue? Is any of it ending up in Russia via somewhere else? And then there was the whole enhanced due diligence, so connections to politicians. You know, you married to a politician? Is your dad a politician? Like all of that. And all of that really was to do with reputational risk. It was so the banks could say, we're squeaky clean, we know exactly who we're working with. And then more recently, over the last 5 years, the banks have jumped on the sustainability and the ESG bandwagon. And there are actually better financial products out there for companies who can demonstrate that they meet these criteria. And in some cases, the banks are tying in covenants. I'm going to say covenants / KPIs. There is a difference between the two, into lending facilities. And so a company will benefit from, say, a 0.5 reduced rate on interest. But in return for that, they have to demonstrate on a quarterly or annual or whatever it is basis that they're meeting these metrics. Yeah, so you can see, to borrow money, there's a lot.
There's a lot that you need to go for. I just want to pick up on a couple of things you said there, actually. So the bit about the know your customer, you said getting that documentation ready. Just for anyone on the call who hasn't ever had to present the information, could you just quickly run through what that is in terms of what they need to get ready?
So it varies by lender.
Okay.
In the main, it's the same, and they just need to check who you are, your business, which they can do a lot of. There will be things like a proof of funds. So sometimes you'll be asked, okay, it's great you started the business. Where did you get the money from to start that business? Okay. Sometimes you can be asked for, well, if you're ever going to take out a personal guarantee, you will be asked for a what's it called, statement of assets and liabilities. Mm-hmm. So you'll say, you know, any property you own and then any debt that you've got. So that, because if you're giving a personal guarantee, if you haven't got anything to back that up, there's a question to the bank of why you take it. You know, there's no good outcome for anybody here, is there? You don't want to bankrupt someone, and so so that's the point of that.
So you almost need to do your own personal balance sheet then for that sort of thing.
If you're going to do a personal guarantee.
Okay, I didn't know that. Okay. And then the other thing I just wanted to touch on before I'll probably forget later on, it was you sort of said there's a difference between covenants and KPIs. And I thought that might be just quite a good thing to just quickly touch on. Yeah.
So a covenant is only applicable legally if it's implemented with a termed facility, so a 5-year facility. And the covenant is there to allow the bank to break the contract, right? A KPI, so you breached your contract with the bank because you haven't met your debt service covenant. That gives the bank the opportunity to well, for one thing, it flags this business isn't doing what we hoped it would. And the bank can then go, right, as a relationship director, you'll then be on the phone to the client saying, look, we're not quite hit it this month. What's happening? And there's 9 times out of 10, there's a good reason why. And it's often just an accounting thing. Something's hit at the wrong time in the month or something. And so then you can just send out a letter just saying, you know, we're acknowledging that you've breached the facility. We're happy to overlook it this time. Please don't do it again. If you look into it and actually you realise that the covenant's been breached because something material has gone wrong, so there's a claim against something somewhere, or there's been a fraud or whatever it is, then the bank can say, actually, we're not happy with this. You're not where we thought you were going to be, and we want to exit, and can you please repay us? And the bank is fully legally entitled to do that and then follow any procedures it wants to follow can't legally follow to get the money back. Now, a KPI is a key performance indicator which the banks use for lending facilities or banking facilities which are not term debt. So an example might be a 12-month overdraft, so short-term facilities, not long-term facilities. And the KPI is kind of measuring the same thing, but in a slightly less formal way, and KPIs can be a bit more flexible. So if I was to give you an example, when I banked manufacturing businesses and we provided trade facilities, so we were paying suppliers for the client overseas, and then the client would repay us once they got paid or draw down on their invoice finance line, the KPIs we would have for the trade facilities would be around stock. So we would say stock less than 180 days old, which is not obsolete, you know, depending on the stock product. And so they would have to calculate that every month and say, this is the stock on the balance sheet. These are the bits of stock you've said you're not funding or you're not happy for us to include in this calculation. And then it would be a ratio. So you would want to see that the stock is X amount bigger than the trade facility.
Right.
Taking into account the reduction on the value of the stock in a gone situation. So if you've got £1 million stock, you might have a 400 grand trade facility. So they might say 2 times cover on the trade facility, but it's not a covenant. They can't just call in on the trade facility if you don't hit that month. But it is something that the bank will use to track the performance. It's just to make sure it's working as it should be and everything's all on track.
And when you said term loan there, you said 5 years, but could you have a term loan that's a different number of years? So like a 3-year, that was just your example. Okay.
And for commercial mortgages, the banks are just coming back to the market with 25-year terms. They've been at 15 with 25 by exception for quite a long time. And they're just looking at going out to 25 again. So it does vary. Most term loans are less than 5 years. Most debt funds will say 3 to 5 years.
Okay. No, that makes sense. Just the question that you answered there was for the what information do lenders and investors require. The question I actually asked, but it might.
Sorry.
The signal isn't brilliant today, so it might have blipped out. But it was actually what does the business owner need to be cautious of when they are reviewing the loan or investment documentation, like the agreements from the banks or the investors? What do they need to be careful of reviewing?
Well, they have to be 100% sure that they know what they're signing up to. So look at the amounts, look at the terms, look at the covenants, look at the circumstances when the bank can call it back, look at the consequences of not repaying. So all of that. And I've sat in front of companies and given them, I mean, they are thick letters, giving them thick letters, and they're just merrily signing away. And I'm like, no, please read it.
Read it.
I think sometimes just business owners feel like, well, this is my bank. I don't really have a choice but to sign this. And to an extent, you know, there's something in that. And also they just want the funding and they're confident they'll repay it. So what does it matter? But I would say if you can, just get a lawyer to explain it to you in English, what you're actually signing up to, just best practice.
And it's those covenants, isn't it, that we see that catches business owners out. You know, if they're not aware of them and you don't have the ability to track them, then that's when you could get into a lot of trouble, especially if they are covenants rather than the KPIs. Yeah,
the covenant monitoring definitely catches people out. And sometimes, especially, I don't know if I should say this or not, but with people in the bank that are less experienced, they haven't realised, yes, you know, the bank has its standard covenants, but sometimes you need to tweak those to make them fit the business model. So it might be like if the business is investing a load in CapEx, you kind of want to know about that because you might want to add back CapEx spend in the calculation. If you're accepting there's going to be that CapEx investment and you've seen that in the forecasts, whereas if you're taking CapEx off because it's a standard calculation, you might not hit your covenant. So it's tedious, it's wordy, but make sure you understand the definitions of the covenants and then also that you can get the data from your systems to calculate them. Because that can be another blocker.
And this is like, if you were helping a business owner get finance, this is, I guess, your value add, isn't it? In terms of like translating that. So instead of, I know you're being sort of very kind and sort of saying go and talk to a lawyer, but equally that, you know, you would be adding that value in terms of if you were involved in like trying to help the business owner get the financing.
Yeah, part of my role would be, is the covenant reasonable? So if they're saying we want 2.5 times cover, and I'm thinking no, for that risk and that rate and that amount and blah blah, you're 1.8 or 2. So we can look at getting better, more favourable covenants. But it's also the understanding, and sometimes just not having that covenant. So the banks might come in and say we want 3 covenants, and we're going to go, no, the third one's absolute rubbish. Just focus on the first 2. So yeah, it's just having someone who knows where the lender should be. But also when you're working with a broker or an advisor, sometimes like being in that competitive process is the best way to get yourself a more favourable covenant, because we can go in and say, oh, well, Bank A is actually offering this. So if you really want to do the lending, you've got to match them. So
yeah, no, it's good. And I guess that brings me on to my next question, which is, how do you actually know if the price that you've been quoted is fair?
Yeah, ask me.
Well,
so actually I do have a slide on pricing. Where are we here? So very big picture. As credit risk reduces, the price should be coming down.
Yeah, and you've gone your tipping point there from equity to debt in the middle.
Yeah. So top left hand corner, distressed capital, you're really at 30%, 40% margin. It's massively expensive. It's short term, less than 30 days, to facilitate the business not falling over, to allow a transaction or something to occur. Stupid expensive. And then as you're coming down the risk curve and you're going, making more profit and you're coming down there, just thinking, have I got private equity? Oh no, I have got them the right way around, because it's venture debt and venture capital. Yeah, VC and then PE, and then you're going into the venture debt. As you come down, so the venture is around the 15% over base. But again, it depends on the sector. And like with technology, they'll focus more on EBITDA than they will on profit. And if you've got like an ARR business model, you can get funding which is aligned to ARR. So they're looking at future cash that's coming in, so cash flow lending rather than asset backed. And junior mezzanine debt. Now, sometimes the banks find themselves in a mezzanine position, which they weren't expecting. So you might have taken out a facility at 2 or 3 over base. But then, I mean, a classic example of this was on the back of the financial crisis, when hotels had leveraged themselves up to the eyeballs because, the lending, the LTV had gone higher. And then all of a sudden, and they'd taken out a load of interest rate swaps as well. And then the base rate plummeted, which kicked in the higher, the ceiling on the swap. And then the banks went in and said, oh, well, you're not hitting your covenants. We want to revalue all your assets. And so they lent against something saying it was worth 2.2. Now it's worth 1.5 and the loan's at 1.8. And so the bank's in a mezzanine situation there because it's actually below water. And so the bank will say, yeah, I know we've got that term there at 2 or 3, but actually we're at 6 now. And because you're out of contract, because you've breached the covenants, you're then just in an open negotiation.
Wow.
And so the bank will be coming in saying we need 6, and the business will be saying, well, I can't afford 6. I've budgeted for 2. And so yeah, that's a really tough place to be. But the banks do end up sometimes in mezzanine situations. Junior debt is just where you're ranked below someone else. So someone else is going to get their money back before you. So junior debt will attract a higher margin than senior debt because you've got less chance of being repaid.
Okay.
A lot of private debt, for everyone wants to be senior debt. There are some that will take junior debt. And then as you go down to the bottom right-hand corner, your absolute lowest rate you're going to get is if you're a company that's got really nice tangible assets, so buildings, nice, big chunky machinery, lovely debtor book, great stock, like prime metal or something like that. And then the bank's looking at your business and it's got probably security over everything. And it's saying, do you know what, we're really comfortable with this position and we know we can collect out if it goes wrong. And so we're going to give you our absolute best pricing. And down here, some banks might even get below 1.5 for the right business. If it's mature, it's steady performing, it's got great assets, you're going to get huge competition for your debt down there. Wow. And I'd say, so banks will be bottom right, and then somewhere above and to the left of banks, you're going to get your ABL alternative lenders. So some of them are banks, like Shawbrook's a bank, Alica's a bank, and they're not traditional long-standing banks. They're newer banks, but they are taking a bigger risk, albeit it's still asset-backed lending. And so they've got security there, but they might be able to push themselves to a higher position or take a bit more of a punt on a business which isn't performing as well. So the bank might go, oh, I'm really not comfortable with that. You only made 50 grand profit. An ABL lender will go, I don't care. If I'm only giving you 30% against your premises, I know I'm going to get repaid.
Yeah, no, that makes sense. So what about then poor old recruitment firms that obviously don't have assets?
Banks love recruiters.
Really? I guess
Yes.
a cash generative, as long as they can prove the trading history that they are a good business, I guess.
So with recruiters, it's nearly always invoice finance.
Yeah.
And it's because of the debtor book.
Yeah.
So yes, and often there's, it's a really well spread debtor book, really good payers because there's consequences if they don't, the person come back out. And so no, recruitment's lovely. You can get really thin margins on performing recruitment businesses. Yeah.
Yeah, as long as you're performing.
And really competitive.
Is that the same for sort of other professional services firms as well?
No.
Okay.
No. So with accountants and lawyers, for example, what do they own? Some laptops, that rented office space. There's not a lot there. The assets are the people, and so generally their funding will be through an overdraft, maybe a term loan. Smaller solicitors that are partnerships will often borrow just to pay their tax, to spread the tax bill over 12 months or the VAT bill.
Wow.
And so there's that kind of short-term lending. And then as the firms get bigger and more established, the number one funding solution for them is an RCF, so revolving credit facility.
Yeah, okay, no, that makes sense.
Which is a posh overdraft, really.
Yeah, no, absolutely. So
did I answer the question right that time?
You did. You got it right. I'll blame it on the signal because it is a little bit like apologies to everyone, but I don't know. I've tried changing my Wi-Fi to a different one and it's still so that's why I didn't tell you to take the slides down because I just thought actually when probably both of us are talking we're kind of looking a bit like robots, but there's nothing we could do about it. We'll just go with the flow and just apologize to those who are attending. So common mistakes, I guess, is probably the next thing to cover. What do you see? We've covered a couple of them in terms of like not keeping an eye on the covenants.
Keep the CEO out of the room because the CEO is normally like the visionary person. It's a bird, it's a plane. We've got a new product, we're expanding that, and it's like no, just keep them out and keep the finance people in, or the managing director, because the banks want to buy into the story. And if there's someone in the room who's telling a different story, it can create a little bit of nervousness. So I'd say, and have a plan, like have a strategy, have a plan, know your numbers, get your numbers right, because when the banks start sensitizing, if you don't have the answers, again, they'll lose confidence. I'd say, it's really interesting, even in this day and age, business owners can be quite naive and only go to the current bank. And then it's like, oh, my bank said no. And I'm like, well, what about the other 198 lenders in the UK? And so a common mistake, just not looking broadly enough. Maybe as well, sometimes I think we often hear people, especially at the smaller end, are very dissatisfied with the service from their banks. And so don't be scared to escalate, find the regional head of and have a moan. And also maybe not getting advice. I think a lot of business owners, SMEs, they're scared to pay for the advice because it's expensive in the 100%. World. And I think it's a real challenge for them, to invest in an FD is a really significant investment for a lot of people. And actually, lots of small businesses don't necessarily need the experience of an FD, but there is that sort of tipping point, that growth curve where they start to need that. So I'd say, don't try and do everything yourself, which is probably what they've done to get where they've got to, but start to recognize your strengths and bring in other people around you And sometimes that is getting an advisor who is specialist in something, whether it's a lawyer, an accountant, a banker. Get someone you can just talk to about what you're trying to do.
Yeah, and I think that's exactly right in terms of, we see this all the time, that nervousness about probably even contacting us to, because they think they're going to be missold, like a full-time permanent, finance director at 130k or whatever.
Yeah.
But I think that's where the beauty of potentially using, you could probably even get someone on an interim basis, if you haven't got the capabilities to put together, the financial forecast that you would invariably need for this, or the history for the past 3 years. If you haven't been doing those management accounts, you can get someone in just as a project to get that sorted. You're not necessarily having to commit like you probably did back in the old days, to a permanent full-time person, and that's I guess where the fractional finance director model comes into play, I guess.
Yeah, no, absolutely.
No, that's good. And I guess in terms of if someone is sort of thinking, oh, I need to get some external finance, what would you suggest is their sort of their first steps? I mean, you've obviously given some idea in terms of where they need to be before they even have those conversations, but what would you suggest?
Calling me.
Obviously.
Yeah. The earlier you talk to someone, so yeah, well, joking aside, speak to your bank or any other existing lender you've got, speak to me, someone like me, and just talk about what it is that you're looking to do, because I think having that conversation early can really just broaden your mind about different ways you might be able to do it. So a great example of the technology business that I'm talking to at the moment, and they've got about 6 or 7 facilities with 6 or 7 different lenders, and they've done nothing wrong there at all. The guy's done really well to get that funding, but he's kind of he's weathered the storm of moving over to a subscription model himself, which is a huge cash cost, to do that. And he's done it by, a bit of money here, and then a year later, a bit of money there. But actually, if we'd had the conversation 2 years ago, there's probably 3 or 4 loans that he didn't need to take out. We might have been able to move on to an ARR funding model, which would have funded the growth, and it would have been cheaper. And so I'd say, just talk to someone about what you're trying to do early on.
And just on that, so obviously people are like going, oh, it's all very well saying talk to me, but you're going to charge me an arm and a leg. Maybe you could just talk through, like, the model in terms of who's making money where, and just maybe put people's mind at rest.
Yeah, so it doesn't cost anything to talk to me. Obviously, it's different. So I'm used to working as a debt advisor in an accountancy firm. We would do a really big scope of work for a client. So we would take all the data, all the financial data, analyze it all, and present back and say, this is your optimum debt structure. These are roughly the covenants we think, and based on everything you've given us, these are probably the lenders and maybe the cost. So there's a lot of work in that. No, I don't do that work. I'll listen to what I'm told and I'll give an early opinion. So it's, nowhere near, there is no cost for that at all. And then the next stage as a full-on advisor and accountancy firm is that you would take the debt to market. So you produce a 80-page IM and you take that out to several lenders, and then you narrow down and negotiate and work out a couple to move forward with. Well, I don't do an 80-page IM, I do a 2-page exec summary, which gives the lenders enough of a flavour to know if they're interested or not. And then what I do is facilitate the data requests from the lender with the data that's coming in from my client. So the lender says, can you give me 3 years sales forecast? Often the client will send you 2. So it's like, okay, and I'm that one in the middle going back and saying, no, client, they need 3. Can you give me, and so I'm smoothing through that communication breakdown, which often happens between the bank and the client, because they're both busy doing different things. Sometimes things are just not explained properly.
And just on that, I'm sure most people listening do know what IM is, but it's information memorandum, just for those that don't. So just thought
Thank you.
I mentioned that. No, that's quite all right.
And then so the way I would get paid in accountancy as an advisor I'm billing for all of that work that I'm doing. You've got a team of people working on it. and then you're project managing to completion and working with the lawyers, tough negotiations, all of that. As a broker, I'm getting paid.
That was his historical. So you would historically charge the client for all of that work. But that's when you were in that world. Whereas
now as a broker, I will mostly get paid by the lender. So they pay an introduction fee when you bring something to them. It's not always the case. It does depend on the type of lending, and it depends on the lender. But most of the time, it's not actually going to cost the client anything to use a broker.
And on that then, so what I would say is someone who could potentially be your client, how do I know that you're not just telling me to go with this product because you are getting a better fee with them than giving me the whole of market thing? Because, we're all very nervous of that sort of practice happening.
No, there definitely are brokers out there that do that for sure. And I think the best way to trust someone is to be introduced through someone that you trust. And so, I get referred into people, and it's usually from people I've worked with, so they know I'm ethical. I also have on my website, I will always be transparent on fees. And also I'm appointed an authorised representative of Funding Friends. So I use their FCA licence. And part of that process, we actually have a document which explains exactly what we'll be earning. So it's completely transparent.
Okay, no, that's fantastic. I was just going to say, Leanne, I think I've covered off like all of my questions, but was there anything that you feel that I haven't asked you that we've missed at all?
Don't think so. There's always more I can talk about.
Well, and I think that's, your door is open for anyone that wants to get in contact.
I'd say probably the only thing that we haven't really touched on is how vast the lending market is now versus 20 years ago. The majority of lending was done by the high street banks 20 years ago, and that is switching over to alternative lenders and debt funds. They're taking over. And so I think back in the day, people could work in an office, in a city, a town, village, wherever, and they would know their local bank manager and they trusted them and all the rest of it. Whereas now the banks they don't have that presence anymore. And you've got all of these new entrants to the lending market, and it's completely impossible for any finance professional to know absolutely everybody. Now, I probably know about 60 lenders, which is, trust me, enough. But one of the benefits and one of the reasons I joined a network rather than fully going alone was because they all know different lenders. So collectively, we've got a really good coverage, but you can't do that alone. And so the world has changed.
Yeah. No, fantastic. And I just want to apologize again for the quality of the video today, the image, because it's very, I don't know if I'm doing the same your end, but you're kind of darting around all over the place this end. Sorry. So but no, it's all good. It makes for an entertaining show. So no, I just want to thank you so much for your time. Obviously, if people do have questions, we can answer them in the chat afterwards. So in the comments bit. So please do put your questions in. And this becomes like evergreen content ultimately on LinkedIn. So if you're watching this on catch up, you can still add a comment, and then we will pick that up in the future. So thank you so much again for your time, Leanne. I really appreciate it, and I hope you all have enjoyed watching it. Thank you.
Thanks, Kate.
No worries.